Before we get into today's episode, don't forget to sign up to the book and the VIP newsletter at thehighestandbestuse.com. For the book, you can get that at Amazon, Chapters, Barnes & Noble, all of these places in paperback, ebook, hardcover, and of course now the Audible version as well. So grab the book, sign up to the VIP newsletter, thehighestandbestuse.com, and now to today's episode.
I'm Serena Holmes, and the highest and best use for my business is private lending.
All right, thanks for tuning into the Highest and Best Use Real Estate Podcast, where we talk techniques to optimize your land, structure, skill sets, and time, as well as the highest and best use principles to make your business more profitable, productive, and efficient. I'm your host, Ryan Carr, reminding you that good deals are found, great deals are created. Super excited for this. Today we have Serena Holmes on the show. Serena is a realtor in Southern Ontario. She's a spectacular private lender, and she's also the author of The Accidental Entrepreneur. So, Serena, welcome to the show.
Hi, thanks for having me.
This is fun.
Yeah, it is.
It's so funny because we met on Facebook, Instagram, somewhere in there.
Like that, yeah.
And now it's become a real in-person. So today we're going to talk about the good, the bad, and the ugly of private lending.
Yeah.
And what makes that highest and best use for you.
Yeah.
Before we do so, kick it off. Tell the folks a bit about yourself.
Yeah, so you obviously gave me quite the intro. I think one thing that you didn't touch on was, before real estate, I actually ran my own business for 18 years. I just exited from that business at the beginning of last year and tried to actually sell it literally 3 weeks before we went into lockdown. So good luck selling an events business in a pandemic.
Oh my goodness.
But I was able to actually get a mutual release from the company I hired last January and had it sold in 2 weeks.
Nice.
So now I've been focusing on real estate full time.
Cool. How did that transition look for you? As an entrepreneur going into real estate, like what changed? How did your perspective shift and why?
Mm-hmm. Well, I had a coach in 2013. And at the time, the biggest takeaway from her was that I had too much money in the bank. She's like, what are you doing? Like,
good problem to have.
A year and a half of operating costs. And I was like, well, I always want to be able to pay my bills, pay my staff. I don't know what you don't know as a business owner,
sure.
Right? Especially a young one. And she encouraged me to take some of that money out to invest with. So I ended up buying a short-term rental in Florida back when the dollar was at par. So that was my first real estate investment. And then when I came out, I was like, I don't know what to do now. I kept it for 4 years and sold it. And I just didn't know what to do. Yeah. And we started staffing events for Keyspire in Texas and Florida. And they just ended up on my radar. So I ended up going to one of their wealth tour events with Mike Holmes Jr. and Darren Voros. Got sucked into the system. Went to their first investor summit and did a lot. So I bought 2 pre-construction properties. I invested in a land development deal, 3 syndicated mortgages. And then through that, a friend of mine's like, you need to speak to my mortgage broker. Like, he does a lot of private lending. I make more money with him than I do, running my own salon. And I was like, tell me more.
Tell me, yeah.
So at the time, Keyspire really advocates that you can use your HELOC. At the time, 3%.
Rates are cheap, yeah.
Loan out at 20%, you make that spread, right?
Yeah.
So I started kind of lightly with him. I had a certain amount that I wanted to work with. And then once the pandemic came, then I was able to dial that up, registered my real estate license because I felt that was complementary to everything that I was doing. And as a private lender, you can also analyze the deals a bit better. So you can look at things on GeoWarehouse, and there's certain tools that you have access to.
GeoWarehouse is great, isn't it?
Yeah, you wouldn't be able to have,
so
right?
Good, yeah.
So I'm able to now do, a certain level of due diligence that I wouldn't have been able to do beforehand. So I've been able to really live off this for the past few years and really talk about the highest and best use. It's the return on time.
Right? I love it.
Yeah, so that's been the best part of it so far.
So what is private lending for anybody who doesn't know? Let's go back to basics.
Yeah, so it can take many forms. I mean, in terms of real estate, there are a lot of people that do private lending to raise money either for a down payment for a property, renovations, land development. There's all different things that, in the real estate community that's taken advantage of. But what I learned is that most people actually don't use their own money. So you just think where do they have this money to do all these things? It's collectively all
somebody else's,
other people's money. Yeah, so they obviously have a system in place for that. But when I started, the broker that I was working with, he was a mortgage broker. So maybe someone has to wipe their line of credit clean for 2 weeks before their mortgage closes. Maybe it's a business loan. Once someone wanted to buy a plot, a burial plot, it could be these random things that they suddenly need this little influx of cash.
Can you lean a burial plot?
Probably not. So you gotta
be like, no, you can't go in there until you pay your debts. I don't know.
Well, that's exactly right. So it's sometimes you want to know what are they using it for? What's the recourse if they don't pay? For the most part, they are vetted by, in that instance, the broker. But if it's not through a broker, then sometimes you would have your lawyer look over certain things, and most lawyers will say don't do this. Yeah. Because the agreements all tell you
lawyers
lose your money. But
they have the place. They have the place.
Different things. I would say the majority of what I've done now has been more real estate focused, but occasionally I will do the other kind of private deals. It could be random.
Yeah. Return on time. Let's talk about that. I love that you said return on time because it's so important in this space for me, for everybody. What does return on time mean to you?
Yeah. So when I ran my own business, like obviously, 15 years kind of prior to COVID, and it was very consuming. So as the agency owner, like I had 10 full-time staff, over 2,000 part-time across Canada and the US. You would drop anything, like clients would come to you with these ridiculous timelines. We're working with all these brand ambassadors that you're putting up fires like any time of the day or night.
Yeah.
So when I actually had my daughter back in December of 2019, nobody knew that the pandemic was coming. It's kind of like a blessing in disguise. Like my business stopped operating, but I was able to cut costs and I was able to depend on private lending. So when I used to have 100, 200 emails in a day, now I was getting like 5.
Hey.
So as a new mom, it was perfect that I was like, I could go on walks and go to the park and, have all this uninterrupted time with her that I wouldn't have otherwise had. And
can you get mat leave as a self-employed person? I
guess it depends on how you pay yourself. So in my instance, like I would have taken dividends. So with the private lending, I cut my payback in half the year before I had my daughter.
Got it.
The plan was to probably not take anything during the mat leave. And then I promoted someone in my office to kind of cover me off when it came to sales and guiding the team. And she resigned when my daughter was 2 months old. Yeah. So that's why I ended up actually listing it for sale, like right before the pandemic hit, because I just didn't know how I was going to be able to do everything.
Sure.
I had a buyer lined up, but then lockdown happened.
Stuff happens.
Yeah. So I kept it going just for the purpose of selling it, knowing that I wanted to have that, like, I've put the work in, like I want to have more of the life at this point. So
yeah, for sure. Return on time. I mean, especially having a family, like we don't have kids, but I mean, having a family, that's huge. Private lending gives you that opportunity because you're not doing the doing. Like you're vetting deals and stuff and there's an effort there, but like you're not boots on the ground.
You're not trading your time for money is like really how I've looked at it. Yeah. So, it's really setting up all of those deals. And I like to insulate my risk by just doing smaller amounts with like higher numbers of people. So usually I have anywhere from 15 to 20 deals all going on at the same time. And that way, like I said, even as a realtor, I can choose who I want to work with, who I'm going to dedicate that time. So I'm not like buried in open houses and I'm taking that time away from my family.
What do you prefer to do? Be the private lender or be the realtor? Or both?
I mean, definitely the private lender. Because, it's obviously like less time. Like when you're a realtor, like you could be fielding a lot of phone calls. You could be, if you're working with buyers, like you're not at home, right? So I think I like being able to work by email and phone. Like I think you've got to balance. I do like to see people. It's not like I don't want to.
Just a recluse in the basement, lending out money.
I just want to be a loan shark. But obviously, like there's freedom attached to that, right? So when you're on holidays or if you want to go to the cottage, like you do have that flexibility. Right. So it's good to have both.
So when you're vetting deals, let's talk about risk. How do you do that? Where do you start?
Yeah. So when I started, I'd almost always have a property that was listed in the agreement. That's when you're working just one-on-one with someone. So you'd ideally want to see that there is a property. It doesn't mean that it's registered on title in the sense of being like a secured investment, but there is a level of security because I do own an asset. So there is something where you can put a lien on the property. What I've had my lawyer look into is how much equity is in the property. And there have been deals I walked away from because they had refinanced a few times and maybe it's questionable. Like, what are they using that money for? Like, how much equity is there really left? And what you have to be careful of is even if it seems like there's enough equity, if you're second in line to the bank and they foreclose on the property, there could be a lot of additional fees that the bank charges that eliminates your opportunity to pull that money out. Right. So my general threshold is like 50,000 a deal. Maybe I'll do 100,000 per borrower, but split on like 2 separate projects or 2 separate properties. I still would prefer to just keep that as lean as possible, just so that it's, reduces the chances of things happening.
Sure.
But those are some of the things that I looked at there. When you are looking at larger like land development deals and things like that, it's a lot harder, I guess, because at the end of the day, like the developer just stops working or something happens. It's the value of the land ultimately that's ideally going to pay the debtors,
which is never worth
like that.
Is what people think until it's actually done.
Exactly. Right. Yeah. So I think there's probably a little bit more risk in those situations.
Would 50K go very far for a developer?
Probably not for development. Like, I mean, you're probably one of many borrowers, and I have a lot of, for example, there's my Key Spire coach. Actually, I'm invested with them and another coach. They're doing 2 redevelopment projects in Cambridge and like Burlington or something like that. And I think we're one of 52 borrowers on the one project.
Oh, wow.
So it's set up in a GP LP structure. And what I've learned even with that is that, they'll give you an estimated time frame. So you have to plan on possible delays. So, and also if they have promissory notes that they brought on top of that structure, technically the promissory notes get paid out before the LPs. So it's an interesting thing to be aware of, because you're technically like a partner in the deal. So any like third party debtors get paid kind of before you as a business owner, whether you're GP or LP, gets paid.
Really?
So I think sometimes there's the illusion that that's more secure, but in fact, it may not actually be the case. If
I didn't know that.
Shove, so
I didn't know that. A prom note getting paid out before
an LP.
Could a prom note
because you're like a shareholder of the business, right?
Right.
So,
even on the GP side, though.
I'm not saying on the GP side, on the like as an LP. So what I've been like from my real estate network, I was kind of told you're in a better position as like with a promissory note than you are as an LP, because if the business suffers financial hardship, the prom notes will get paid out before the shareholders of the business.
Interesting.
So
would that get registered like a construction lien if something went bad?
I've never had to do that, so I'm
don't know.
100% sure. Like I guess we'll see, but
interesting.
I've never looked. Someone recently just told me about that, and they're on the opposite side. Like they're the GPA and they're the active partner, so they're saying actually, like you would think that this is better, but and I was like, oh. It's just like listening in.
Tell me more.
Just to see, because obviously I've got both. Like sometimes it's promissory notes, sometimes I have been an LP, so it just depends.
Interesting. Okay.
Yeah.
I'm really curious about that now. How that behind the scenes, the mechanics of that. Interesting. In terms of after you've vetted the person, what happens next? Are you going through a mortgage broker to actually place the funds? Are you doing it yourself? How does that look?
I've done both. So there is a big mortgage broker. I think they're in Oakville. So I've got a number of deals with them. And they pretty much facilitate everything. Like they'll do the due diligence when it comes to like insurance on the property, like vetting their credit checks. Like sometimes I'll ask for more as well. Like I'll ask for the borrower's identification, proof that they own the property. Like, yes, they're giving me a pro forma, but I want to have like all these extra things. Just in case. Who
are you?
Well, because yes, they know, I don't know, right? So like I always just ask for as much as possible, just so that if I ever needed it, like I can prove who these people are and stuff like that. So usually you would just kind of send the payment to the borrower directly, and then you send a kind of a separate payment to the mortgage broker. And then in other cases with the real estate companies, I've just sent it to them directly. So it just depends.
Yeah. What makes a good deal for you?
So I mean the return, like I use my HELOC. So obviously like what was 3% is now approaching 8%. It could be like, I don't know, what was the announcement today?
Is it supposed to go up again or something?
They're expecting like probably another quarter point, right? So obviously the spread on 12% is not quite as good now as it was a year ago, right? Yeah. So now I'm looking at deals that are more in that 16 to 18% range. And I think to be competitive, most companies are offering that just because they know that, you know, they have to, right? So
you got to be a sharp borrower to make sure, like if you're borrowing money at 18% or 20%, whatever, right?
Yeah.
Like you got to be a pretty sharp borrower to say, this is how I'm going to pay this back. This is why this makes sense. Because even as an end user homeowner, borrowing, if you borrow $100,000 at 20%, like that's 20,000. That's a couple $1,000 a month. Where are you getting the income from to support that issue or that debtor, right?
So I looked at performas from some of the active investors, and what they've done is like, say they needed to raise $2 million, they might raise 2.5 because they know that they've got monthly amounts that they have to pay out.
Right.
But they've obviously come up with some sort of a plan to like say renovate this property, have it reappraised. The reappraisal might be $4 million higher than an $8 million purchase. So that pays out all the debts, and then they're still making their say $1.5 million in profit. So they obviously come up with that equation to pay things out.
Are they using the extra money to pay the monthly? Is that what's happening?
Yeah. So they're over raising on what they need.
Yeah.
And I'm sure they're also giving themselves a buffer, but they come up with a plan of like the purchase price, what the renovations are, what the carrying costs are. I guess if there is cash flow, like that can play into it and stuff like that. But he actually walked me through like this super elaborate spreadsheet so I could understand, like if you're looking at buying a $15 million building, like how are you doing that?
Yeah.
So he walked me through like all the numbers of like how they'd put that together and come up with that plan.
Whoa, hang on there, Bingo. Don't forget to check out the Highest to Best Use playbook before we get back to the episode. Amazon, Chapter, Barnes & Nobles, all the different places. You can go to thehighesttobestuse.com for direct links, or you can check it out on those websites directly, and you can get it in hardcover, paperback, and ebook. And of course, we talk about the three tenets, the core tenets of the Highest to Best Use: land, structure, skill sets, and time. Those will really benefit your business. Now back to the episode. How do you think interest rates are actually affecting the borrowing environment today of the borrowers, knowing that, okay, when I bought this place 2 years ago, maybe I was planning to borrow at 5%, 8%, 10%, whatever, and now we've doubled. How do you think that's affecting people?
So I think it's affecting people more residentially than commercially. So everyone that I've spoken to, and even recently I joined Wealth Genius, so Alfonso talked a lot about that, is that...
He was on the show.
Yeah, so he was on mine too. So he was just talking about how it hasn't affected commercial rates necessarily as much as residential rates. So I think what a lot of people don't know from the outside looking in is how that's different to qualify for something commercially than it is residentially. So I think for people just buying their primary residence, if they went variable, they could be struggling in that respect. Right. But if you've bought like a 20-unit apartment building and it's commercial, chances are you could be going through CMHC and MLI Select. You've got a lower interest rate, like much longer amortization and stuff like that. So they're not seeing these like considerable rates because of the way maybe the government's approached things commercially from like maybe the housing shortage perspective. Not really sure what the rationale behind that is, but they're totally different environments.
What's MLI Select right now? 4.5%, 5%, somewhere in there?
I think it's lower than that.
Really?
I just heard someone locked in like 3.55 or something like that.
No way.
Like there's some rates that you're like, oh. Yeah, so I think
shocking.
they can be competitive depending on, I guess, who you're working with or what the process is.
Sure.
So they've changed that now. I think they just changed just recently. I heard they were a bunch of people were going through the process of a refi and they're like, everything's going up.
Yeah.
Get your application in.
It's life, yeah.
Yeah.
Like what does a bad deal look like?
Yeah, so it's not really one. It's one company. It was 3 deals. So when I joined Keyspire, they really advocated for one particular company who will remain unnamed. Mm-hmm. And they're like, use your whole HELOC. Like, you can be making this much money. And I was like, well, obviously I'm not going to use all of it.
Yeah.
I used half of it,
sure,
which was still a lot. Like it was $355,000 in 3 deals. And 2 things I would have done differently now with knowing what I know. Yeah. I would have done less. Like I did $355,000 across 3 deals. Now I don't do more than $50,000 a deal. And also they offered split interest. So on say 16%, you got half of it upfront, paid monthly, half at the end when it would mature and be done. And at the time there was a 12-month term, an 18-month term, and 24 months. And 1.5 of those paid out on time. I don't know how there's a half.
Yeah.
But of the 1.5 remaining, we're sitting at 5 years. So way longer.
Sure.
And last update, they're like, they maybe need 2 more years.
Oh my goodness.
Like they finally have a developer and it looks like, it's still indeterminate how long it'll take.
Yeah.
They're going to put a window of 2 years on it. So because it's taken so long and the front end interest has gone on for so long, they were kind of alluding to the fact you may not be able to count on your back end interest. That's up in the air.
Yeah.
So, imagine people that invested in these things not knowing COVID was coming, depending on this money. And then it's like, well, you may not get it for 6 or 7 more years. Yeah. So for me, like all the other private lending I've done has paid off what I invested with them.
Yeah. Yeah.
But it's frustrating knowing they've just kind of held us hostage and it's just gone on forever. Right. Mm-hmm. So
was that a GPLP as well?
So the whole thing's really confusing. Like it was a syndicated mortgage. I thought I'm one of many borrowers. These people are buying a shopping mall. Turns out it's actually not the case. They're land developers as well.
Oh, wow.
So the mortgage brokerage is also a land developer. So the whole thing was really confusing. I'm not going to say they always do that. There are a lot of instances where they have mortgages, but in a few of these instances, it was more land development focused.
Right.
So I think they really misrepresented what they were doing. In the contract, it said they could extend for 6 months twice. Mm-hmm. Clearly, we're well beyond that. Yeah. And the way that they have alluded is like, well, they're still paying interest, so you can't force their hand really as a lender. So we've been all like advised just to.
Wouldn't that be considered a default? If you've extended twice and that was your contract, then you're over that. Is that not a default?
Yeah. So I mean, another company actually was brought in by FSRA to administer the funds because of a couple things that were happening, and they've kind of advised it's in our best interest to just allow them to try to like get it done. That way, hopefully we can get paid back in full and get our interest, as opposed to like trying to force the sale of the land and then probably everyone's going to lose.
Right.
So they've just tried to encourage us to continue to be patient, all these a decade later.
Yeah.
So we'll see what happens. So that's kind of was my biggest learning, is just not to put as much money into any one deal.
Right.
And again, I would just not touch that split interest because there's always a risk on the back end that you may not actually get it.
Yeah, that's true. So let's talk. You said something interesting in there. Like, don't foreclose on the borrower, help them get to the finish line.
Yeah.
Right? Let's talk about that. So I'm of the same opinion. I've never been in a situation, and I've borrowed lots of money, but I always try to be on the more conservative end to say, hey, I'm going to pay my debts and this is why.
Yeah.
But if I was ever in a circumstance where I was having a hard time, I would A, be vocal with the lender, but B, ask for help. Right? Like you as a lender, would you not want to be in that position to help that borrower succeed instead of foreclosing and trying to slam the door?
Well, I would look at that like, yes, you want to help them, but I would also look at that from the lender perspective that you don't want to hold someone hostage.
Right.
So I would think if you do have a situation like that, it'd be nice to know, well, if this is going to go on longer, give them the opportunity to exit and you can maybe just replace them with another borrower. To me, that would make sense. It sounds like from a GPLP situation, you can't do that because if you exit one person, you actually legally have to exit everybody.
Because they're all the same.
that's what I was learning just on a call that I had with one of my investments last week, that it's going to go on just slightly longer, but some people have been asking to exit because the interest was a little bit lower. So they've kind of said, like, we actually cannot exit everyone or anyone, I should say, not everyone, because of that whole caveat. So, you know, it's a good learning. I would think if I'm ever in that situation where I'm capital raising, you just want to be extra clear with people, like, you know, all of the possibilities that could happen. And if those things arise, how you're going to handle it, maybe as the borrower.
Have you ever capital raised with other people's funds through you as a non-mortgage broker and then sent it back out yourself instead of through a company? No?
Yeah, I haven't done that. I do know some people that have like private lending businesses, and I was trying to feel out, like, how do you do this? Like from a the standpoint of securities and stuff like that. And I can't say I really got a lot of clarity. I do have a lot of people that approach me now asking me about those opportunities, and even just from a legal standpoint, I want to protect myself, because I would never want to refer someone and say a deal goes bad. I don't want to be responsible, because I can't control what you do once I've like shared contacts with you. If I say like I do 50,000, you go drop $1 million into a deal and it goes sideways, well, I never told you to put $1 million into a deal. You know, I would say put that into like 20 deals, but you can't control what someone's going to do. So to protect myself now, I'll have people sign like a release and indemnity. And that way, if I'm going to make any introductions, at least they understand like what you decide to do at this point is going to be up to you. And like, I just can't be responsible for that.
I love your risk profile. 50K a borrower, maybe a little more, depending on the circumstance. But I mean, like, it's so simple. It's so cut and dry. This is what I do. This is it. If you need more, I'm not for you.
If you lose 50,000 of $1 million, it's not going to bankrupt you. Right. And, you know, touch wood, the chances of like 20 borrowers all defaulting is unlikely. So that's how I've tried to approach it, just so that if anything goes wrong, you can recover from it more easily.
So let's talk about terminology. So I got a little list here. Vendor takeback. What is a vendor takeback?
Oh, I'm the worst with that.
Okay.
So I'm obviously not an active investor. So I know a lot of people that do vendor takebacks. I kind of understand it from the perspective that if you're going to approach someone selling a property, there's kind of a way that you have a mortgage maybe directly with them for a period of time that you would then take over the property and then get a traditional mortgage when your finances aren't maybe more appealing to a lender.
Beautiful. Second mortgage. What is a second mortgage?
Okay. So you're second in line to obviously the traditional financier. So if you, for example, have a mortgage with RBC, you want to have a second mortgage for whatever purpose that may be, you may go a route of like a B lender or a private lender. So if you default or have to foreclose, the first in line being the bank gets paid first, and then the second mortgage is paid second.
What about a third, fourth, or fifth?
Oh gosh, can't keep the line going.
Just keep it going. So
if
somebody defaults in that chain, what happens to the people further down the road?
So as I understand it, you have to register like a PPSA. So ideally that puts you in line. So if someone does owe money, then if you're you registered first, then you would kind of be next in line to the bank, and anyone else that comes after you is paid in that order. So if you neglected to do that and they owe 20 people, then your chances of getting paid are much slimmer.
Next, a prom note. Define a prom note.
So that's a personal guarantee from the borrower.
Promissory note.
So P-note, promissory note, general security agreement, you know, obviously has many different names, but ultimately it's a promise from the borrower that they're going to pay you back, and it's a personal guarantee. So basically anything, I guess, that they own under their own name technically is up for grabs if they default on a loan to you.
Construction financing. What is construction financing?
So I haven't done that side of it.
Oh, no?
But yeah, like I haven't been active on that side. I probably loaned to people doing that side of things. But as I understand it from like the land development side of things, you raise construction financing that is released in waves as the construction is completed, usually oftentimes from a traditional bank. But as I understand it, a lot of people in land development will use private funds because they can't access that money in advance. So if they want to pre-buy materials, get ahead of certain things, they'll rely on other money because the construction financing is in phases.
Nailed it. Yeah, that was good. That was like off the cuff too.
That's my take on it.
What are you seeing in the market right now in terms of what borrowers and lenders are doing where there could be an opportunity such that other people aren't tapping? Like what's happening in the market?
Yeah, so I liked what you said in your introduction talking about you don't find opportunities, you create them. Darren Boris actually just spoke about that at our event not too long ago. And ultimately, I think you have to find what those opportunities are. And even for me, like I joined Wealth Genius to focus on land development because I want to be able to identify opportunities and then sell them to investors as a realtor. I prefer that to just buying and selling houses. And obviously there's a housing shortage. So I think ultimately the biggest margins right now are in land development, and just seeing some of the numbers and the lifts on certain things, just even to take something to like site plan approval. You know, there's land developers in my group that bought a 40-unit student property, and they're rezoning it to 22 stories. Nice. And their potential margin is 8 to 23 million. So worst case being 8, best case 23. And they're basically they bought it, it's cash flowing in the meantime, and they're just taking it to site plan approval. So it's not to say there's no work involved in that, but that's not even to like do the actual work.
That's just pushing paper, right? Just pushing paper. It's pushing paper.
Exactly. Yeah. So I think just from what I've heard, like it seems like those are the most lucrative opportunities. Another land developer in my group, they are building a subdivision with I think 123 houses. Their capital is going to be at 15 million, and when it's done, it'll be worth like 120 million.
Nice.
So, basically, like winning the lottery in a few years, right?
And that's purely SPA.
No, they're building.
They're going to build it out.
Yeah.
Okay.
Yeah.
That's a good lift.
Yeah.
Do you know what the margin is on that, like from a percentage perspective?
Oh.
Just to give the listeners a context.
What's 15 divided by 120? I don't know. I mean, it looks like a 9. Like.
No, I meant like net after they're all done. Cost.
Yeah. I'm not 100%. I would think that's probably like. Is it 90% or is it like 2,000%?
I mean, if they're going to spend $1 million on the build and they're going to exit at 115.
Yeah, they're going to spend 15 million in capital.
Okay.
Probably like raised by private funding and stuff like that, and it should be worth in the range of 120 when they're done.
Wow.
So, awesome. And I think that's over like a 2 to 3 year plan.
Yeah.
So, don't give me a calculator.
Yeah.
I gotta know.
Can we go taxation? Can we talk taxation?
Sure.
Yeah. Taxation for private lending. What does that look like in today's landscape?
So not as bad as I thought, because I just did my taxes and I thought, okay, well, I'm going to owe a lot more. And actually even my accountant said I'd owe a lot more, and I owed actually half. And the reason being is that depending on how the borrowers issue the T5s to you can impact how the taxation is. So if it's taxed at like a capital gain as opposed to personal income tax, then obviously it's like a lower tax rate. So on what I made, like I think I paid $11,000.
Right.
And I made triple last year than I made in my highest year from my business. So I don't know how that worked.
Do you know if people are taking capital gains or are they taking their interest income personally or corporately or both?
I mean, speaking for myself, like I'll do both. Yep. So, and I use my HELOC. So the interest on the HELOC is tax dedeductible. So my home equity line. So I think that's important. So if you're paying your 8%, just know that that's obviously not like all going into your profit.
Yeah.
And then I didn't intend to use corporate funds into private lending, but I wanted time to figure out my next move. So I dumped it into private lending for a year. So I have it on that side as well, just ideally for a shorter period of time.
So you're just kind of buying some time in the interim and you're saying, hey, like, what do I want? What's next?
Yeah, exactly. Yeah.
So private lending isn't just an investment strategy. It's also a holding strategy for you too.
Well, I looked at it like if I want to take the time to figure things out, at least I'll make money in the meantime. And then I'll have a bigger amount of money to put towards whatever investments when that time is ready. So
do you prefer to be an equity partner in a circumstance for a long term, or do you prefer to just be the money and hands off?
So I think it depends like on the circumstance. Like personally, I've obviously been living off private lending, so I need the cash flow. I have to service my debt.
Right.
I want on the business side to build my portfolio. So I want the long-term equity and I want to be like, 5 years from now, maybe I have 100 units that I'm sharing with one company or a few companies. Yeah. And I want that in terms of the long-term wealth. And eventually I want to know that the capital is kind of recovered and I'm rolling that into like more and more things. Like I don't want it to be where you're stuck in it for 10 years because a lot can happen in 10 years.
Yeah.
Like in a perfect world, your capital is returned in 12 to 18 months. Then you can repurpose it into something new, but it's just not like I said, held hostage for a long time, but you're building that equity in the long-term wealth.
Do you like being active?
Yeah. I mean, I'd like to learn more and be more active. Do you mean like active physically or active?
No.
Okay.
In real estate. Active as a real estate owner. Do you prefer to be an active partner or do you prefer to be purely finance? Like, I know we just talked about some of the benefits of it, but like, what is your preference if you had to choose?
I'm learning more. Like, I feel like I'm so afraid of like the Securities Commission. So, I want to learn.
Delicate, gently.
Well, everyone I've talked to is like, you have to have an EMD, like an exempt market dealer just to avoid this. And you got to be careful of that. And, Canada's not as litigious as the States, but you still have to protect yourself.
Yeah.
So I think I do want to work towards being that active partner and help, a company to scale the right way. But I'm learning all those things. Like I wouldn't just dive in and be like, I'm just going to go and raise $2 million by myself. Buy this. Like people do it, but like I feel like I have a bit more to learn before I can undertake that on my own.
Got it. Makes sense. Okay, I've got a quote here. Metaphorical quote. Ready? Fortunes have been lost to liquor and leverage. Metaphorically, do you agree or disagree?
Yeah, of course. Yeah, I think they can be made, but they can also be lost if they're mismanaged. I think it can go either way.
I like that. Okay, so we talked taxation. We talked a lot of the things. What makes this highest and best use for you? On the alternative to time, we talked about time. That's really important. Is there anything else that we've missed, maybe that we haven't covered in terms of why is this your highest and best use strategy or one of?
Yeah, I mean, obviously the time is a huge thing, especially when I look back at the last 20 years and how many holidays where it's like I spent on email or I'd sit in the bathroom like 2 hours before my husband woke up, like working and like not having to do those things. So the time is a very, very big thing, and just the work-life balance. But I think the other thing is just being able to be smart with the money that's coming in. Like I don't ever use like all that I have. Like I keep myself pretty modest. I use what I need. And then I've just constantly keep on paying down the HELOC so that when certain things mature, like it'll be like these bigger nest eggs that I can continue to like put into other things. Right. So I've used it to like pay off the land deal I invested in 5 years ago, to pay off the syndicated mortgages. Like, so all of those things are just inflating what I have coming back. So I've tried to be as smart as possible with that. So I think it's like the time's one side, obviously the money's the other side, but just trying to grow your legacy and grow your wealth and all of that in the long run.
Legacy, you wrote a book.
Yeah.
Yeah.
I did.
Tell us.
Yeah. So like you said, it's The Accidental Entrepreneur. My whole life I'd been told like, you got to write a book one day, because my childhood was a little crazy. And I feel like it paved my path into entrepreneurship because of the challenges that I had. And, if I had grown up in one of those like perfect families where, your parents are just paying your way, like, I'm not going to say you can't be a good entrepreneur, but in my instance, I knew no one was going to hand me anything on a silver platter. And I had to work really hard just to like put myself through school and get ahead and stuff like that. Offered the opportunity to be a partner on a business, and then the partner left 4 years in. So we went through a buyout in the recession. So it was literally like just by accident, but I continued to run it for 14 more years. So the book ultimately talks about that foundation and what I experienced when I was growing up. So my parents split when I was 4, and then my brother passed away in an accident that really should never have happened about a year later. And, obviously that caused a lot of distress and trauma in our family, and led into a lot of different things, and ended up living with an aunt and uncle throughout most of high school. And, was out there trying to get a job like as soon as I could. And as I got older, I would take like 5 jobs. I was like just always trying to make ends meet and get ahead and stuff like that. Right.
Do you think life kind of work hardened you as you went through, or?
I think it just, I always said yes. Like it doesn't mean I would necessarily like it and continue, but I would always say yes to opportunities and be like, may this be good, may this be good. But then I was able to kind of fend for myself in a lot of ways and get ahead. And my whole goal was just like, I want to buy my own house. Like, I don't want to be a burden on anyone. Sure. So I bought my first house when I was 25, and I just, continued from there.
Awesome. So. This has been so much fun. I mean, from this side of the mic, I appreciate your tenacity and your genuine expression for real estate and the business, and being a yes person. Obviously you just mentioned that, and it's sticking with me because so many people are no people. And I think too many people in this world are wired to say no. Yeah. And they shut themselves off from opportunity, and you clearly haven't done that. So again, from this side of the mic, from me to you, thank you for being here.
Thank you.
This is a lot of fun. Where can people find out more about you and your book?
Start the list. Yeah. Well, I guess Serena Holmes Realtor obviously is one of them. I also have other profiles. So Inspire to Invest podcast. That's a podcast for real estate investors and how they got started, as well as for my book, Serena Holmes Author.
Awesome. Serena Holmes, that's it. Thanks for tuning into the Highest and Best Use Real Estate Podcast. Don't forget to sign up to the book at thehighestandbestuse.com, Amazon chapters, Barnes & Noble, all those places, and Audible as well. So like, share, follow, and subscribe, and we will see you on the next episode.